Hi, everyone, and thanks very much for joining us for the second in our series of institutional crypto webinars. I'd also like to thank our guest today, Dave Weisberger, who is the co-founder and CEO of CoinRoots. Dave, thank you very much for being here.
Well, thank you, Noel. It's a great opportunity, and it's a fun topic to talk about.
It certainly is. And before we dive into that, I'd just like to give our listeners a brief rundown of the format. Dave and I are going to chat for about 45, 50 minutes. I assure you it's going to fly by because there's so much to talk about. And then we're going to pull up the list of questions that you very kindly sent in, and Dave will do his best to get to a few of those before we wrap up in 60 minutes. So I'd also like to remind everyone that this will be recorded and uploaded to the CoinDesk webpage as soon as we can so that you can listen to it again or share it with your colleagues. And with that, I'd like to just dive right in. Dave, I've been so looking forward to talking to you because you're one of the few people in the sector who's really been working at the intersection of finance and technology for long enough to have seen not one but several changes. Can you give us a summary of your background and leading up to how you fell into the crypto space?
Yeah, it's an interesting story. I mean, sadly, sadly because I've been in this a long time, so I guess that makes me old. I started in program trading.
Nothing sad about that.
I started in program trading a long time ago. I actually built the first program trading system in the U.S. and then again in Tokyo for Morgan Stanley. And then the following decade, which was the 90s, I started the Solomon Brothers Global Program Desk. And Solomon was very into quantitative trading and quantitative technology, and I got very involved with that. So as part of all of that, I became their market structure, I hate to use the word, but we'll say it, expert. I did things like I built their first central risk book, their first VWAP algorithm. I actually was musing the other day that it was 20 years ago that the first algorithm that I ever built went into production. And I remember the two guys whose jobs it took. Quite literally, there were names on them. I don't want to name them now, but in fact, that's what happened because the algorithm outperformed by quite a bit, actually 4 cents per share, which was quite a bit at the time. And so that progressed, and I ended up running statistical arbitrage and electronic market making for Citi. And at the same time, I had been an early advisor to a routing company called Lava Trading, which, funny enough, Citi bought, and then I ended up running in 2007 and 8. And that got me very well involved deep into market microstructure. After 2008 happened, and you might remember there was a little blip in the world economy back then, and Citi had some troubles. I and tens of thousands of my friends left Citi. I went to a company called Two Sigma, which is a extremely well-run quantitative fund based in the United States, where I started their wholesale market making business and ran their broker-dealer. And so once again, very deep in market microstructure. I left there in 2015. I went to a software company which got purchased and purchased again, which afforded me an exit opportunity. So a couple of years ago, I was looking for my next opportunity, and my son came to me with the idea that crypto markets really needed what he called exchange mediation. Now, Ian, who's my co-founder, whose idea was for CoinRoutes, was someone who had been involved in Bitcoin from the beginning. He kind of was looking at it from afar. His career started with web hosting companies that he built 13, 14 years ago and sold. He then did a genetic infrastructure for data and was published on a peer-reviewed paper with a group of geneticists from Mount Sinai when he was 17, then spent years in ad tech building high throughput systems and time in fintech building transaction analysis. So he had a little understanding of all this, and we sat together a couple of years ago and came up with the company that's CoinRoutes, which we're not going to talk about today, but that's how I got into crypto. And I find the whole thing quite fascinating, and you'll see some of it or hear some of the reasons why as we go through this.
Actually, before we do go into some questions about the nuts and bolts, what does CoinRoutes do for those in our audience who aren't familiar with it?
Right. So we are based on 3 patent pending innovations. We do consolidated market data, both with fees and without fees, and that's very important in crypto, and a full suite of algorithms for clients to trade. Our model is sort of unique, and the first patent we applied for is for a distributed router, meaning that our software is client deployed, they hold on to their wallets and keys, and can trade taking advantage of our central market data nodes, which are processing all that consolidated data. And we process about 8 terabytes of market data a day. So we get to see a lot about what's happening in the crypto and digital asset markets.
So it sounds like not only do you have a high-level view of all the changes that are happening, given your background, but you're also deep down in the nuts and bolts. I mean, there's really anyone better to talk about what's going on down in the entrails, let's use that word, of the crypto markets. But
Yeah,
let's kick off on an attempt to clarify what we mean by crypto exchanges. How are they different from traditional exchanges, equity exchanges, for example?
well, there's three major differences: legal, structural, and behavioral. And we'll talk about all three. So legally, and I'm not a lawyer, so I don't want to dwell on it, but it's worth mentioning that equity exchanges are fully regulated, and most importantly, the word regulated is often misused. When an equity exchange is regulated, they're regulated from the perspective of investor protection, i.e., the investors who are buying and selling on the exchanges, their protection is what people care about when you're talking about regulation. Whereas most crypto exchanges are regulated as money transmitters, where the only thing that they're regulated for really is safeguarding the principle of the asset. They're not regulated on things like best execution that we'll talk about later, where equity exchanges most certainly are. I mean, the analogy that I would use here is like a store. A store that might build their building and build a store might be very approved by the zoning board in that town, but that doesn't mean, so they can claim they're regulated, but that doesn't mean they're regulated to the quality of the goods on their shelves. And so, crypto exchanges don't really have regulators in the sense of protecting investors, and that becomes important.
And why did it evolve? Why did it evolve like that, do you think?
Easier, right? Investor protection is expensive.
And
requires work, and there's things that are missing. But I want to talk about the other two differences because there's a bad and a good. We'll start with the good. Structural differences between crypto exchanges and equity exchanges are one of the reasons I'm so bullish about crypto and digital assets in general. And the reason is because crypto exchanges are natively multi-currency and natively multi-geography. Now let me explain. If you looked at any exchange, whether it's the London Stock Exchange or the New York Stock Exchange, they trade a asset. So let's say Vodafone or IBM. And Vodafone trades on that exchange in British pounds, and IBM trades on the New York Stock Exchange in US dollars. That's it. So if you are outside the country, you trade in another currency, it could be difficult to access those prices. Crypto exchanges could trade the same asset against dollars, pounds, euros, yen even, Bitcoin, Ether, or any one of a number of stable coins. That multi-currency being native is a very big difference. It means that people, and the asset itself is fungible. You could buy it in one and sell it in another, and that is a very large globalizing factor. They also tend to take customers from multiple geographies directly. The regulators, because there aren't regulators that stop that, is probably the biggest reason, but that allows for cross-border transactions to be significantly easier. I think that is going to be a major driver in adoption of digital assets, to the point where I tell people, and the people in the traditional finance markets think I'm a nut job when I say it, but I think that all assets will be digital within 25 years. I think there's large amounts of vested interest that's going to fight like hell to stop it from happening, but at the end of the day, economics always rules, and if it's much more efficient, it will happen. So that's the good difference. The bad difference is behavioral. And what I mean by that is that crypto exchanges tend to operate as islands rather than as part of an integrated market. Some of them are vertically integrated, where an exchange can own retail-facing platform, a trading desk, their exchange, of course, and custody. And all of those individual business units can have conflicts of interest between them and their clients. That, of course, hurts investor confidence. The other part is, and what I mean by that, I could give examples and you can ask later, but the other big thing is best execution. Because an exchange ignores the prices on another exchange, it means that people buying there could have problems. It's interesting, but a few minutes ago I was watching the market, and on our software we were able to detect an actual arbitrage opportunity existed for the better part of about 15 minutes. And that's because there were bids on one exchange, and I won't name them, that were $50 higher than offers on another exchange in Bitcoin US dollars. Now, obviously, this happens on other currencies all day long, but it doesn't usually happen that often in Bitcoin. But it happens when the market fell from around 990 to about 39.10 at the bottom tick. During that period of time, these things open up. Now, that shouldn't happen. Exchanges should have some notion of where other exchanges are, but there isn't. Now, in the equity side, that can't happen. In Europe, there's best execution rules. So people who are trading on the exchanges are responsible for making sure they're not trading at the wrong price. In the United States, there's Reg NMS, and it stops exchanges. They're not even allowed to trade through other exchanges' prices. So that's a very, very large difference.
Do you see that changing in the near future? Does the structure of the crypto market lend itself to something like best execution regulation?
Well, I think that my answer to that would be the same as many very important people in the crypto sphere would be. I think the industry needs to, whether you call it self-regulation or simply stop throwing money away. I mean, if you have technologies such as ours, and there are others, but technologies such as ours that scans and trades across exchanges, you will save money. You will make more money as an investor. It will happen. That will occur. I mean, we've seen it already to some degree. I mean, a year ago in December, you had periods of time where on one exchange, the bid for Bitcoin was 19,000 and plus. And at the same time, you could buy more Bitcoin on another exchange in the same geography for less than 17,000. Now that was basically a license for arbitrageurs to make money. And so now you have a situation where the arbitrageurs exist. And so the prices don't go as far out. But still, you could get $100 differences or $50 differences very often. Eventually, investors will get tired of losing that money and will adopt more multi-exchange trading models. In fact, institutions are almost certain to demand that.
I was about to ask, yes, the institutions, the traders themselves, investors, in fact, will probably be the ones to close the arbitrage gaps and force the exchanges to improve their technology to have a better view of what's going on in the market, no?
Yeah, I believe fundamentally, and frankly, to use my poker playing logic, I mean, I'm all in on this concept exactly. That is exactly what we do. We believe that institutions and even significant investors, and frankly, if I was a miner and I was selling my coins, I wouldn't want to consistently lose 50 or $100 in slippage on my coins just because of the way that I trade. And that sort of thing is happening today. You know, look, when price of Bitcoin went from $1 to over 10,000, and then obviously bubble went up to almost 20. But in that run, nobody cared about 10 or $50. So, those double-digit dollars didn't really matter. You were making so much money, nobody cared. But today, where Bitcoin is where it is, and all the other digital assets are where they are, these numbers add up, and they compound on your returns to the point where if you're a money manager, we talked to one crypto manager a year and a half ago. They said they were trading on one exchange, and we pointed out that they're losing 40 basis points compared to if they used, because we looked at their coins, we did analysis for them. And they decided, well, it doesn't really matter. We're trying to make 30, 40%. We don't care about 40 basis points. Well, we saw them a couple months ago. They closed their fund, and they told us that 40 basis points compounded across all their trading would have probably made the difference in being open now, and so they felt bad about it. Well, sure, those things happen. Yeah. I think people will vote with their feet, and and they will use their wallets, and that will ultimately drive change.
And that does make sense. There's also a whole lot more competition now for the market return. Many more traders, many more funds in the market than, say, 4 years ago.
Sure.
And CoinRoots is one of the players in the market that would help with best execution, and that you do provide a sort of bird's eye view of what's going on in the market. Am I understanding it correctly?
Yeah, I mean, we come at this holistically. We have everything from a benchmark called real price, which allows people to see what the price to buy a particular quantity of coin is. So a great example. So real price now, for if you want to buy 5 Bitcoin, I will tell you it will cost you roughly, with a consolidated order book of all exchanges with fees all in, around $39.63 and change. You could sell at $39.56 for a midpoint of $39.60. Why that's important is that gives you the ability to know what should it cost to buy or sell. If you compare that to popular websites, it's very different. So I told you the mid price is around $39.60. Right now, the largest website tells you that Bitcoin is 4,017. I'm not going to name them because I don't want to get in trouble, but the second largest website is at $39.85. Once again, $25 high. And another popular website says it's $39.68 as opposed to $39.58. They're only about $10. Now, interesting, CoinDesk, your website, your prices are much closer to the market. The only time your pricing, as I understand it, comes from dealers, and that sometimes disagrees, but right now it's almost exactly right. And
that's very reassuring.
Well, sometimes the dealers have a position. They may be leaning short or leaning long, and in those cases, you may be $5, $10 one way or the other, but that's not that much of a big deal. When you get to the bigger, more popular websites where people are relying on it for pricing data, some of them are just completely wrong. And that is a serious issue. So we allow people to see what the real prices are, and we allow people to measure what it could cost. We could literally tell you at any point in time exactly what it would cost if you want to do something silly. So if I wanted to be silly at this instant, and I say silly because it's not the optimal way to trade, but if I wanted to sell 2,500 Bitcoin right now on the wire and hit all the bids on all the exchanges, I would be paying more or less $39.20. That's with fees, which is about $42 below the market. So it's a little over 1%. Now, you could usually do a lot better than that by trading algorithmically, but it gives you a really good idea of where the liquidity is. So if you're talking to an OTC desk, or frankly, if you're running an OTC desk and you don't have this is technology that will allow you to measure what you're going to trade. So we have measurement. And then we also have trading algorithms, which understand crypto market structure and trade. But this isn't meant to be an advertisement, so I'm going to stop there.
Yeah, I imagine that investors themselves, end investors, will want their traders to show that they've got the best price they possibly can.
Once again, I certainly hope so. I think
now, why do the prices differ so much from one website to the next? What is the main root?
Greed is one reason. I mean, the reality is the biggest single reason could be described right now. So if you looked at all the exchanges that have no restrictions on deposits and withdrawals, they're trading right now around 39. I told you it's moving around. So right now it's around 39.65. But if I added in an exchange that has deposit and withdrawal fees, and that happens to be well known, and once again, don't want to name them, but if I added that in, their bidding right now, their best bid is $40.37, so it's almost $80 high. That exchange, because they have a high profile, gets averaged in these websites, and it's just flat wrong. People only have a bid on that exchange because they have deposit, withdrawal restrictions. They can't get their dollars out, so they may as well buy Bitcoin there and just trade self-contained, which is not a sustainable model, but it's been doing that basically since October. So that's the reason why the websites are wrong. There's also a problem that a lot of these websites use self-reported trades, and trades are different than what we do, which is off of the bidder off of the quote book. Trades, there's no surveillance against wash trading, or there's nobody assuring that the trades actually happened, or that the price, the buyers versus the sellers, what happened to the fees. Some exchanges report the fees always from the buying perspective, which artificially inflates the price reported. So there's all sorts of issues, but the big one is the inclusion of exchanges that should not be included.
And apart from the very wide range of prices from the wide range of exchanges, be they reliable or not, there's also a plethora of indices emerging to try and give a representative price. What's your take on that?
Yeah, this is one of those things I teased in LinkedIn that I'm likely to say controversial things. I think that the vast majority of indices I think the vast majority of people who do indices, if the market were regulated, would be spending more money on attorney's fees than on literally anything else. I frankly agree they shouldn't exist. I will go back a long way in the index world. I told you I was involved in program trading from the beginning. I was an early inventor on the second ETF ever invented for Morgan Stanley called Opals. An index, to my opinion, is an entity or a calculation that allows you to weight assets in a particular combination to create an optimized portfolio. What in the case of Bitcoin indices, they have perverted that to not to weight the asset because it's only one asset, but to weight the exchange quotes or exchange trades. That's ludicrous. It's absolutely ludicrous. It makes no sense. And I think that the people who do it are simply doing it for greed purposes. I say greed because index is synonymous with derivatives, and people are used to paying index providers for those indices. Now, I recognize this is very widely distributed, this webinar, but I want to be very clear about this. An index for Bitcoin makes no effing sense. What we do and what people should do is the same thing they've done in every market. So in equities, until there was a closing auction, in every market that I know of, the price that was used for settlement was always the midpoint of a consolidated bid and offer at the time that they chose to do it. Now, if you wanted to make a time-weighted average of that, that's okay. You could do a time-weighted average either every second, every minute, every 10 seconds, every 10 minutes. It doesn't matter. But you should be looking at a consolidated order book and using that for determining your price. That's what we do, and that's what makes sense. The notion of arbitrarily weighting an exchange based upon some arbitrary, non-transparent method of weighting is literally an excuse to be able to charge money. A benchmark for a price is not an index. A benchmark should be something that is completely transparent, that anybody with the wherewithal to process 8 terabytes of market data a day should be able to calculate. And so I feel very strongly on this topic.
What about for fund valuation? Do you see a potential use case there?
Even more important for fund valuation. If you look at every fund, mark to market at the close of business on a day is what they do. And that mark to market in every case is always based on, in electronically traded markets, on the consolidated midpoint. Now you can pick which exchanges are in, but here's the difference. In an index, you don't pick the exchanges that are in, which is digital. It's binary. You either include the exchange or you exclude the exchange, period. In an index where you might weight an exchange at some arbitrary amount, that's ludicrous. It should always, the weight, as it were, isn't really a weight. It should be based on the bids or offers that are on the book at the time. Now, if in the case of crypto, because it's 24/7, you say, well, there is no close, that's cool. So then pick a period of time during the day and either take the snapshot of the consolidated, quote at that time, or take a time-weighted average of the consolidated quotes for, let's say, every second in the last 5 minutes of that period of time. So you can do it at wherever you want. Now, crypto is interesting. You may want to even weight it differently. You may want to take it for fund valuation based upon the close of books based on the geography. So I could see a fund in the United States saying, yeah, okay, 4 o'clock, Eastern Standard Time is good. If I'm looking in the UK, maybe 4:30 Greenwich Mean Time is where you want to do it, and vice versa. But at the end of the day, the notion of arbitrary, non-transparent methods of calculating a price that's for a single asset, to me, is something that the industry should not be doing.
You mentioned earlier the unreliable volume figures coming from some of the main exchanges, and that would certainly affect the indices that use prices weighted by volume. How prevalent is the wash trading that you see anyway? And given the amount of attention the press is starting to pay to this, do you see any changes coming in how exchanges are monitored, at least?
I want to answer this question, but I also don't want to speculate. Let's just say that we see wash trading occurring, and you can tell certain things. So I'll give you an example from our side. There are people out there that market trading algorithms. They market their ability to do volume-weighted average price, VWAP algos, and others that do participation algos. I've refused to offer those to our clients so far. Now, the reason I refuse to offer them to clients so far is I don't like giving matches to children, and I certainly don't want to give algorithms that will lose people money. Unless the person absolutely insists and wants to pay me to do it, in which case they'll get it with a big warning sticker. Now, why do I say this? I say this because there is a time-honored tradition in capital markets of people setting up firms who do nothing but try to profit from trading based upon the stupidity of others. When we bought ATD, when I was back at Citi, they had 10 people in a brokerage, in a division, which what they did is they built trading strategies trying to sniff out other people's algorithms or sniff out other market structure problems and make money against those algorithms. They did nothing illegal. They simply were watching for stupid patterns. So think of it this way. If you're trading a VWAP algo in crypto, let's say you have a big buy order to buy 2,000 Bitcoin VWAP.
What does VWAP mean?
Volume weighted average price. So if someone offers you a volume weighted average price algorithm in crypto, I would basically slam the phone down on them for this reason, because that algorithm will do the following. If it sees a large print, they see that 300 Bitcoin got traded at a price, the algo will think, uh-oh, I'm falling behind. I need to buy. And so it will get much more aggressive and start buying. Well, think about this from the outside. If somebody can do wash trades, they can do a wash trade for 300 Bitcoin. If they see that immediately causes the price to start moving higher, they know there's an algorithm out there. So what will they do? They will slowly buy ahead of that algorithm, and then when they're ready to sell to the algorithm, do a big wash trade and have offers in the market significantly above where they bought, and therefore basically legally front run that algorithm. this sort of thing happens, and that's why there's a reason for people to do wash trades. There's other reasons have to do with exchanges trying to build market share, or trying to claim that it's a good place, or trying to get listing fees from people saying, hey, we look at these volumes we have. All of it's bad. The problem is there's no way to stop wash trading until the exchange actually says, we don't allow this, we surveil for this, and we do things about it. So there are examples, once again, don't want to name exchanges. There are examples of exchanges taking NASDAQ Smarts or Eventus Systems. I think there are some who might be using Trillium. These are all anti-manipulation softwares that the exchanges can utilize to look for and try to stop wash trading. And I think that that's what's going to happen.
That could become a marketing tool for the exchanges themselves.
Yeah, most certainly.
And does the wash trading that you see exacerbate volatility?
Well, I just explained an example precisely where it can. You know, it's hard to say, really, because a wash trade doesn't exacerbate volatility unless it tricks algorithms or other people into trading. And if it does that, then it can exacerbate volatility. I think that reality is it's not so much about volatility, it's about making and profiting at the expense of investors, of uninformed investors. I think that's a far bigger problem with wash trading and a lot of the other potential manipulation that goes on.
And is that something specific to crypto, or have you seen this happen recently in other areas as well, other assets?
Well, I mean, there are lots of cases. Everything from, spoofing and layering is manipulation, and, people who, insanely believe that one dude at his parents' basement in London caused the flash crash, which is laughable, but, it probably did exacerbate it a teeny amount. The fact of the matter is that there have been lots of cases and quite literally hundreds of millions of dollars of fines for people who try to take advantage of the system. So a market that's completely unregulated with no fines or no ability to do that is going to create a doubt on the part of institutional investors. That's really the issue here. It is very important to understand that you have a level playing field when you invest, and so I think it's a big deal from an institutional point of view.
Yeah, and also sounds like it makes us feel slightly sorry for the regulators, even the amount of whack-a-mole that they would have to play to keep up with this.
Well, I mean, look, we have a particular problem in the U.S., which is that we have two regulators it's sort of like there's an old cartoon, people playing doubles in tennis, where the ball goes straight down the middle and everyone says, I thought you got it. Well, in our regulatory environment, it's more like the opposite. It's like they both want it, but neither one has the official ability to do anything about it. It gets into issues about the Bitcoin ETF, right? The SEC does not have the ability to directly regulate Bitcoin spot trading, but they do have the ability to approve or disapprove a Bitcoin ETF. So to them, I think it's more a question of, well, I can't regulate the spot market. I'd like to see these following things better in the spot market, and therefore that's why they're withholding the Bitcoin ETF approval. Now, the reality is most of the things that they're concerned about in the spot market are either solvable or solved. And, we can talk about what I mean by that. But the regulators have a hard problem because, remember, their charter is to protect investors. The same is true with ESMA and with the FCA and people in various other jurisdictions. Regulators are charged with protecting investors from outright fraud and from market manipulation. And so it's a hard job. And the better exchanges, the better participants understand this and are trying to do things to make that better.
Yeah, and also the CFTC not being able to regulate the Bitcoin spot market is because they don't regulate commodity spot markets, just commodity derivatives. But they haven't needed to, up until now, regulate commodity spot markets. That seems like it might be changing.
Well, that's an interesting question. Historians would disagree with you. I don't know enough about it to call myself an expert. But when the Hunts cornered the silver market back in the day, they definitely got into some legal troubles. So, and that was in the spot market. There's all sorts of allegations in precious metals, etc. But the reality is the futures markets are actually larger than the spot markets in precious metals. And so the CFTC can regulate the futures markets, and that's probably enough. There are plenty of tinfoil hat people who believe that the gold markets are manipulated. Wouldn't take very long to go on the web and find 100 different theories of how those markets are manipulated, yet they have futures and ETFs and everything about it. I have no opinion on the subject except, to understand that there are those theories. So I don't know what they can do or can't do, but there are definitely certain things that are different with Bitcoin, Ether, and digital assets in general. Most notably, they are far more evolved in their electronic trading of the underlying spot than precious metals or oil or any of those other things. Those markets tend to trade electronically in the futures, but the spot markets are auctioned for the most part, or websites, or all sorts of stuff. I think that the crypto markets are actually far more evolved. Now, I'm not saying they're better, but they're more evolved.
And easier to physically deliver as well, unlike oil or corn, for instance.
Much easier, which that's last year's issue, when I specifically, before the CME came out with their contract, I specifically said they should come out with a physically delivered contract because there's no reason not to, and it would eliminate the settlement risk for arbitrageurs. But new entrants are coming in the market that are going to do precisely that. So we'll let the market determine it at this point.
Yeah, and also it probably was the easier option at the time. And pulling back a bit, I wanted to ask you, what is the main difference between an institutional grade crypto exchange and an equity grade crypto exchange?
Well, there's two questions there. There's what's the difference between people who claim to be institutional grade as a crypto exchange and people who don't. And is that the one you really want me to answer? Because I'll answer that one first.
Yes, let's go with that one first.
Okay, so the difference is half marketing, and then there's some other pieces that are real in some cases. So institutional grade exchange probably means that the clients are actually looking at the prices. If you look at some of the exchanges out there, they have a retail platform that the retail clients pay substantially higher costs to trade, and they're more like retail brokerages than like retail exchanges. Then you have exchanges where the prices are publicly displayed. So, for example, right now, you have publicly displayed prices in Bitcoin, and you can take a look right now. The best bid on the exchanges that we look at, using ones that are eligible for U.S. investors for the moment, is at $39.68, and the best offer is at $39.65. Now, I would make an argument that none of these exchanges are truly institutional grade. I don't think anybody who's claiming to be institutional grade is institutional grade right now, because they all ignore best execution. It goes back to the point that I was making before, that crypto exchanges tend to operate in an island. So if I were to tell you what would make a criteria for institutional grade exchanges, it would be that they have real-time feeds that are bulletproof, that they have a very high uptime SLA, service level agreement with their users, that they have the ability to supply drop copies, that they have a testing environment which uses real live market data, that they have the best execution baked into the cake. They take in other people's data, and either they route out or they suspend trading for periods of time when their prices are wildly different. Those are all things I think that would be an institutional exchange. Sadly, I know of zero that qualify at this moment in time. Now,
do you see that changing?
I certainly hope so.
Yeah,
we have a software that could actually help any exchange make those qualifications. We actually have most of those components available that we could sell them. There are other people who could do the same. But the point is, institutions want to know that the exchanges they're dealing with truly are institutional. Now, that being said, what generally people mean when they say institutional grade in the crypto sphere is also very important. They mean, generally what they mean is your assets are 100% secure. So there are exchanges out there, once again, not naming names, this is on the good side, that safeguard, that actually insure their customer assets and make absolutely certain that they are safe to trade with. That upgrade and spend a lot on their technology to make sure that their technology is always working and will insure clients against technology failures. Those are also aspects of institutional grade, and I think that that is generally what the crypto exchanges would describe as being institutional grade. So to that degree, there certainly are differences in the level of quality between exchanges.
You mentioned uptime earlier. Do you see that as being a problem in the crypto exchanges?
Sometimes. It's really rapidly improving. I think that 3 years ago, it was a big problem. I think that 2 years ago, it was a problem when there were big moves. Last year, there were some notable examples of multi-hour outages. I actually can't remember the last time that we saw a multi-hour outage at one of the major exchanges. So I think that the exchanges are all investing in the technology to improve it. This is very similar to the way that equity markets developed. There was a time in the mid-2000s when every day some exchange would go down for some period of time. There's a actual legal term called self-help, where you were legally allowed to avoid, and you are allowed to avoid trading on an equity exchange. There were periods of years when almost every week there were multiple self-help declarations, meaning there were downtime problems. These days, it's noteworthy. You would read about it in the Wall Street Journal or the FT if, in fact, it happened. It doesn't happen very often anymore. So in that regard, crypto is following a very normal, significant progress towards better performance.
And the structure probably lends itself to that as well. For instance, in traditional equity markets, for instance, if an exchange goes down, your broker-dealer would route your trade to another one. But in the crypto world, if I understand it correctly, there aren't any broker-dealers that route to exchanges. People tend to deal, well, there are, but in general, people tend to deal directly with the exchange, which is a big difference.
That is true. That is true. It's not as different as you think, because in the equity markets, there's products called direct market access, DMA, they use the expression, where whether or not it's the exchange offering it, and it isn't, it's broker-dealers that offer it, there are tens of thousands, hundreds of thousands of people who have direct access to trade on exchanges. They just happen to be provided by broker-dealers who provide the AML, anti-money laundering, KYC, know your customer rules on exchanges, and that's pretty much the same around the world. That said, in the crypto world, most of the exchanges also operate what I would call very similar to like broker-dealers. They're far more like broker-dealers with their own ATS, or alternative trading system, or MTF, multilateral trading facility, depending on which side of the pond you're on, than they are exchanges in the sense of a regulated exchange that's a national utility. But so there really isn't a difference that way. The biggest difference in the crypto world is, frankly, from what we understand, and I don't have good access to this data. Tab Group did one study. I've seen several others. They say anywhere from 60 to 80% of the market happens away from the exchanges OTC. And there are lots of people in the OTC market that basically are pure middlemen. And they don't have any notion of where the trading really is, except by calling yet other OTC brokers. And the exchanges are at the bottom end of the food chain. That is a bigger problem.
And how do you see that evolving in crypto? Let's talk about the OTC markets. What do you see happening there in terms of trends?
Well, I think it's really interesting. I did a talk for Markets Wiki from John Lothian several months ago. And effectively, the way I see it is the market in crypto today looks a lot like the early 90s did in equities in Europe. So in, say, 1993, 4, 5 in Europe, most of the actual volume, if you looked at volume, was done in the city of London through market makers that were the big banks or big dealers there. They had a system called CX International where they all posted really wide spreads, but people picked up the phone and called the dealers to get a price every time they wanted to trade. And that was about 80% of the market. About 20% of the market were trading on the electronic markets, they were all electronic in Europe much earlier than people realized. It was something called CATS OS in Spain and started in France actually, and in Canada. And there were electronic markets came in virtually every European geography. The OMX markets, which NASDAQ now runs, they were trading electronically in the 90s. Something that's now called Xetra was in Deutsche Börse. It was called IBIS at first, was trading electronically, and that was about 20%. Eventually, within about 10 years, actually less, all that flipped. And so instead of 80% trading OTC, it was about 20% OTC and 80% electronically. And that's probably more or less where crypto is going to go. And why is that? Trading OTC makes a lot of sense when a client demands immediacy, he needs capital, or an extremely large position that they need to try to get, and they want to get matched with natural buyers or sellers, maybe what in stock trading they might call a secondary offering. Other than that, it really shouldn't be done. Other than that, what will happen is, yes, you might well want to hire an agent to trade for you. That's a great idea because there are people who can help, but they're going to trade on exchanges algorithmically for about 80% of the orders, looking to find the other side, trying to find a natural, by trading in whether it's a dark pool or by various methods that will electronify. So there's definitely a need for OTC desks. There's definitely a need for those sorts of people, and there's a need for both principal trading, which will probably stabilize at around 20%. Principals where a dealer commits their own capital, and the rest will end up trading algorithmically one way or another. And that's more or less the steady state that we'll get to. But in crypto, it's really the way it used to be. So that's sort of how I see the evolution. It almost certainly has to go that way. And the reason is dollars and cents, or pounds and cents, or euros and cents, or pounds and pence, I guess. Because at the end of the day, it's cheaper to trade algorithmically than it is to pay 3 or 4 middlemen in a trade.
And what do you think the move to algorithmic trading might do to volumes, but also volatility and price movements?
Well, we know what it'll do to volumes. They'll go up. When this change happened over the period of time, both in the U.S. and in Europe, volumes went up by a factor of close to 10. Because as frictional costs go down, as commissions come down, as fees come down, as spreads tighten, real spreads for trading, the investability of the asset class increases and volumes go dramatically higher. I mean, we saw that.
And the confidence as well. No?
Yes, so it also improves investor confidence. I mean, when an investor knows what the price of an asset is, they're much more willing to trade it than if they have to guess.
Yeah.
And that's the big difference.
What kind of time frame was that?
Well, in equities, there were different ways. In the U.S., we saw the evolution take place from, there was a famous settlement where the NASDAQ dealers were colluding with each other to keep spreads artificially wide. That got settled in 96 or 7. There was a regulation called Reg ATS and a series of rules called the order handling rules that came in. And within 2 or 3 years, you saw lots of them sprung up, competing markets. They were called ECNs, electronic communication networks. They weren't exchanges, but they're more or less, publicly displayed markets. Eventually, that all happened. By the time we went by 2002, when they also went to pennies for quoting spreads, volumes had increased on NASDAQ stocks by a factor of 10, and from a volume perspective, and spreads had collapsed. It took a few more years for the New York Stock Exchange effective monopoly to be broken by something called Reg NMS for it to happen there. In Europe, it was much more gradual. It was over the same period of time, but more or less happened. There, it was like a 5 to 10 year period. I think the world moves quicker now, so I wouldn't expect it to take quite so long for those things to happen in crypto. I would say we're looking at 2 to 3 years max before we end up with substantially higher volumes traded in a more electronified, more normalized market. I mean, frankly, that's the bet we're making. So, I hope I'm right.
And the traditional markets, if I understand correctly, there's a wide range of algorithms of all different types. Do you see a similar spread of variety happening in the crypto market?
Absolutely. Absolutely. There's different needs. Like, for example, just the way I look at it, there are 5 types of algorithms broadly, but underneath that, there are many more. So just to put it in perspective, our algorithm suite, we actually exclude one of the 5. We exclude the volume-weighted ones, trade-weighted, trade-weighted ones, so we'll ignore that. But just of the 4 that we support, we have 14 different parameters that can be set, which literally can create thousands of combinations. You will see other people doing the same, but just to make so people understand what the 4 types of algorithms are, you have time-weighted. So spread the order out over a period of time and keep it evenly keeled over that period of time. You have scheduled. I want to get the whole thing done within this period of time, but I'm happy if I get it done immediately if I get it at my price. You have opportunistic, which says, I want to get it done as cheaply as possible. I don't care how long it takes. So I get it done in a minute. Awesome. If it takes 2 days, I'm okay with that, right? So different levels of patience and there's different ways of doing it. And the 4th one is market pegged, where in one way or another, either to one or more markets, you want to float with that market specifically until it's done. So either at the midpoint or at the offer, whatever, but you are pegged specifically to a market without any other intelligence. So more or less those 4, and if you add in volume-based, either based upon what's trading in the market today or what the average that we expect to trade, different ways of doing that. Those are the 5 types of algorithms. Other than that, there aren't any others. It's just that there's lots of variations and parameters that you can use within that.
Do you see a preference for one type over any others?
It's not really a preference. It's really more what you're trying to do. I'll give an example. If you're a buyer and you believe Bitcoin is going to go to, significantly higher in the long term, but you have no opinion of where it's going to be in the short term, and you're very, very patient, you're probably wanting to be opportunistic. If you're working a client order and you're working, let's say for the sake of argument, it's a fund who is buying 10 currencies, right? And they want to get all 10 more or less in the same time. Well, then you're much more likely to want to put all of them on the same schedule so you're not overly exposed to one versus the other at varying times. And so therefore you might be, those are the two levels of extreme, and there's various and sundry needs in the middle. If you're a market maker, you're going to do things very, very differently, or a swing trader where you're trading maybe for a day or for an hour, you can do things very differently than someone who's a long-term investor. So it really depends. It's different tools in your tool belt as opposed to one is better. There's no such thing as better. There's more appropriate for what you're trying to achieve.
Yeah, now where I was heading was that there isn't any one particular trading style that predominates, which I suppose would lead to a healthier market. Yeah,
it's healthier. The only thing that you should, there's do nots are easier to say, but do not trade on one exchange at a time and ignore other exchanges, which by the way is the dominant method people trade today. Basically that's taking dollars, or pounds, or euros, making a big pile out of it and lighting it on fire. You're throwing money away when you do that, yet that's the dominant method of trading. And the reason for that has nothing to do with whether an exchange is a good market or a bad market. In fact, most of the exchanges are actually really, really good. They do a really good job. They've gotten much, much better. As I said, they do excellently. But the problem is, and we have statistics on this, there is a lot of rotation. Once again, not going to name names, but I was talking with a friend who's a quant in Chicago, and he was saying he was looking at Exchange A, and he said, we were looking to build a model that when Exchange A showed momentum, i.e. it got to be a higher price or a lower price than the other exchanges, we would buy when it got to be a higher price and sell when it got to be a lower price. And I laughed at him. And he said, oh, so you know the story? And I said, yes. And the answer is that tends not to be the case. When one exchange tends to get higher than all the other exchanges, much more often than not, the other exchanges catch up. You would be far better off selling on the exchange that got higher and buying on the exchanges that didn't. And so it's very important. The quants would call that mean reversion. We used to run mean reversion strategies when I ran StatArb. And so, that sort of individual correction where they're all jockeying with each other and circling is very important. When you look at any individual day, it's really rare among the top 6 or 7 exchanges that any one of them has a market share on the best bid or the best offer over 30%. Really, really rare. Now, it depends on the day. Sometimes an exchange might be biased. They may have more buyers than sellers. But during most periods of time, the market shares are very, very evenly spread, and they tend to rotate pretty quickly within minutes or seconds, not even within hours. And so that's important. I'm just looking at the last 24 hours. And in the last 24 hours, if we only look at bids or offers for at least one full Bitcoin, there's not one exchange with more at the bid than 30%. In fact, there are 2 that are just about 30 but are underneath it, and then a few that are in the teens. And then on the other side, on the offer side, the highest, there's one exchange at like 26.2%, and then the next one is 20.5%. But it's very evenly split. And by the way, the offer side is different than the bid side, typically. So what you're seeing is if you're trading on one exchange at a time, you're probably losing money.
I have a ton more questions I'd like to ask you, but we did promise the audience we'd try and get to some of their questions. So let's move on to that, and then we'll wrap up at the end with a couple more. Sure. You have a list in front of you of some of the questions, and I'll let you take the first pick of what you feel like answering.
Well, the first question was, what's the biggest trigger for large institutional involvement that we can expect to see? And they put a time frame on it. I won't. I would say that it's really about price discovery, anti-manipulation, and frankly, regulatory guidance, I think are the 3 big triggers. Price discovery, meaning, institutions want to know that people are solving the problem of assets being safe. I haven't talked about that because it's not my area of expertise, but there are lots of people who are working on that. You've seen Fidelity come out with their announcement. They're doing that. You've seen announcements from BitGo. You've seen announcements from others. You also see places that exchanges that have announced that they are going to insure customer deposits, and so people could be safe. So that's very important, but that problem is more or less being solved. But what isn't solved is the perception that the markets can be manipulated, or that we don't know what the price of the asset is. Where am I going to value it? Those sorts of things. That needs to get solved. And it's solvable, obviously. I mean, we have solutions for it. Other people have solutions for it. But I think that's a big deal. I think the one everyone is expecting to see the answer is the Bitcoin ETF. And that is really interesting. Look, I am very, very sympathetic to the SEC situation here. I've shown them that we could put a feed on ETF issuers' desks or ETF issuers' websites that show precisely what it will cost to buy a full amount to create or redeem an ETF. And that should solve the problem if those exchanges are the ones that all have anti-manipulation software. I think at that point, the SEC doesn't really have a strong reason to say no, but that doesn't exist yet. It's not publicly displayed. It should be. And the anti-manipulation is not 100%. It's getting there. So I think those are the big deals that will be triggering. But I think the real issue is, and this is the one people don't like to say, but it's going to be FOMO. I mean, I have, my kids are in college, so I'm all familiar with what FOMO means. What FOMO, those old people like me, is fear of missing out. At the end of the day, there's pretty good evidence that says that crypto is very uncorrelated. And if you take any view that goes back to 2015 or before, portfolios perform better with crypto as part of them, even with the catastrophe that happened in 2018 with crypto prices. So that's another big thing that will happen. And I think that we've seen that trend peaking in. And I think digital assets in general will be a big part of that, as things become more digital and easier to trade across global and in country lines.
I agree with you. In the Institutional Crypto newsletter, which went out a couple of days ago, I wrote an article about how there is no key to institutional investor involvement, and we're looking in the wrong places. And then after I published it, I realized there is actually a key, and the key to institutional involvement is institutional involvement.
Yeah, I agree with that. That was actually a really good article. I think I retweeted it or something. Because
thank you.
You're absolutely right. And it points to why a couple of places that I won't name, because I said I'm not going to name them, were basically said they were retrenching to focus on crypto folks rather than institutional folks. But I think what they're really saying is that today's volume is being driven by people who want to be in digital assets, and that future will come from people as they get converted. And I think that's wise strategy.
Yeah, totally agree. Do you want to pull up another question?
Yeah, there's another one about arbitrage between exchanges and how much longer. The answer is yes. And that's actually kind of funny because right before we started this webinar, arbitrage opened up. And the answer is it happens most days on some coin or another. On Bitcoin, maybe once or twice a week you see it. But if we look, I happen to have pulled it up. If you look over the last, it was while this thing happened, we saw our arbitrage channel going where you could have made, it looks like around $50 for a period of around 15 minutes by arbitraging between exchanges if you were set up to do so. Now, people say, well, you can't move, coins from one exchange to another, and that's true, but the real professionals know what to do. The real professionals are able to establish positions on every exchange that they may want to buy or sell on and hedge those with futures, and therefore can hold those positions and can then do arbitrage. So it is possible to do. It still opens up. People's technology isn't perfect, and not everyone has the full capacity to trade. But I do think that it's getting less and less over time. But there's still, as long as exchanges operate as an island, there will be money to be made doing arbitrage one way or another.
And even in the one you saw today, 15 minutes is a long time in markets for an arbitrage opportunity to exist, no?
Oh, it's a long time. It's a long time, but remember, I'm old. I remember building arbitrage systems in the late 80s where we used to use manual tickets people would trade on the New York Stock Exchange, and that got faster and faster. And it took from like 87 when we were doing this at large scale to pure arbitrage where you could make money just by buying and selling the same instrument with nothing intelligent. Didn't really disappear until 5 years later. At which point you could make money by using statistical arb signals and other sort of things to trade. There are other different ways you can go at it. But arbitrage will always exist to some degree. It just got faster and faster. That the time got smaller and smaller.
Yeah, and there's only so much that technology can do, right? Do you want to pull out one more?
Yeah, there's, let's see, view on security tokens. I think that one of the things that's interesting about security tokens, I think is fascinating, is why do we care? Which is to say, the reason we care is because there's no good regulation and people don't know what to do with the crypto exchanges if they were all being regulated as securities. Ultimately, everything will trade with the same investor protection as securities. That's the important thing to understand because it's really not that onerous, or shouldn't be. Now, the U.S. rules are Byzantine. And frankly, most of the rules that we still trade under in the U.S. date from the 40s, actually the 40 Act and the 34 Act on the Exchange Act. So there wasn't even a computer back then. So to have them understanding digital assets, it's obviously wrong. There is a need for overhaul of these rules to actually fit what crypto does. But the issue that will ultimately happen is more and more assets will become digitized because digital assets have enormous benefits. The ability to trade against multiple currencies simultaneously, the ability to attract a truly global investor base. That to me is the biggest area of expansion. It's what I think the real juice in the sector is, not whether or not Bitcoin will be a winner. And it's important because there's another question here is what are the fundamentals driving value? I'll answer that at the same time. I want to be really clear. Bitcoin, in my opinion, trades as an option. Effectively, it's binary. It will either gain critical mass on a global scale as an accepted store of value, or it won't. If it doesn't, it's worth zero. I don't want to argue with it. If it does not get critical mass, it will eventually fade away and die. On the other hand, if it gets acceptance as a store of value or as a means of transaction, it will be worth many, many, many multiples of what it is today. I mean, the classic example people use is digital gold, but what it is doesn't matter. And it's not in the United States that this war is being fought. The United States, we have the dollar as a reserve currency, so we're pretty laissez-faire about these things. We just know that our dollars spend pretty much anywhere. You go outside the United States, that's not true. And there are lots of places where Bitcoin is needed. So to my mind, the single most important thing driving prices should be adoption rates, should be how the Lightning Network is helping people who have Bitcoin to spend it, how Bitcoin, wallet addresses are growing, et cetera, et cetera. Those are things that should matter. But in the short term, markets are driven by supply and demand. And understand that there's a famous expression, market can remain irrational for longer than you can remain solvent. Now, I don't know whether it's irrational low or irrational high. My personal bet is it's irrational low, but it doesn't really matter whether I'm right or wrong. I'm not an expert on this. What I will say is the fundamentals of crypto in general is there a value proposition for the particular digital asset that you're talking about? Bitcoin's is based upon adoption. Ether is based upon its usage, as are many of the platforms. And then there's others that are based upon what they are trying to do. And there's lots of different value propositions. People need to evaluate the value propositions in the long run and understand in the short term, everything is driven off supply and demand.
That's an absolutely beautiful note to start wrapping up on. Well done on that. One thing before we let you go, one question I want to ask you. What are you most excited about this year? Put another way, at the end of the year, looking back, what for you was one of the most interesting developments of the year?
Well, what I'm most excited about is obviously being very self-interested is how we can scale coin routes and help use both our technology to help people invest better and also our pricing to help make that market more palatable to institutions. Now, that's very self-interested, so that's probably not the right answer to the question. The right answer to the question to me is how much the building that's happening is going on. One of the things that's been stated by a lot of people in crypto, and I absolutely agree, is that you figure out when there's a crypto winter or whenever there's a bear market, the firms that are investing, that are building the important technologies are the ones that are going to ultimately matter. And we saw this in the internet bubble. Who are the biggest players in the internet right now? One of them, Amazon, survived through the bubble and existed beforehand, capitalized financially upon the bubble by being able to sell convertible debt, et cetera. But two of the other biggest, Facebook and Google, were built during the period of time when everybody else was saying, I can't fund an internet startup. Are you kidding me? I just got killed. I think that you'll find that the winners, I believe, maybe some of the original cryptos or one or two of them will be the big winners at the end. But I think this year is a building year. And And people who are building and not just marketing are the ones who are going to matter the most. And that's what I fervently hope to be excited about. And I'm excited to see a lot of building happening.
I totally agree with you, and we're lucky to be able to be here to see this. Dave, I want to thank you so much. This has been an amazing conversation. I could happily have sat here and talked to you for another hour, but I imagine both you and our listeners have to get on with their days. So seriously, thank you, and thank you, audience, for joining us.
Thank you, Noelle.